Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three top-ranked, beaten-down stocks to consider buying right now amid the massive market rally as we look to end 2023 on a high note. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the three stocks that we're going to talk about, which are DocuSign, Nike, and Target, I want to just quickly go over where the market stands in the recent rally we've seen. So Christmas came early for the bulls after the Fed officially held its core rate steady on Wednesday, but more importantly, the world's most important central bank also projected 3 rate cuts in 2024, so turning super dovish heading into the new year. And I'm recording this on Thursday afternoon, and at the moment, the Nasdaq, the S&P 500, and the Dow are all up again to fresh 2023 highs. So the dovish outlook for the Fed confirms what the bulls have kind of been pricing in for the last several months, which is lower rates next year and the start of cuts. So we saw all 3 major U.S. indexes hit new 52-week highs. The Dow actually hit a new record. And the S&P 500 and the Nasdaq the S&P 500 is approaching its all-time highs from early 2022/late 2021. And the Nasdaq's not too far away from those highs as well. So the bulls now appear to be pretty much in total control and might be able to press 2 fresh all-time highs in the coming days and even weeks. All this strength came before we even entered the official Santa Claus rally period. So that Santa Claus rally, you see a lot of headlines about it, even though it technically refers to only that 5-day, the final 5 days of the year and the first 2 trading days of the next year. So starting last year, we saw our 7th straight Santa Claus rally where stocks were higher during that 7-day stretch. And it's been higher during that 7-day stretch about 80% of the time back to going back to 1950. So amid this recent wave of positivity, we have even more reason to be kind of bullish heading into 2024. And as I said, as interest rates are set to fall even more, we're seeing more and more money come in off the sidelines and say, hey, I liked my solid 5% return, but I see all these growth stocks booming again, I don't want to get left behind. So you could see even more people race to get back in the markets and lead stocks to go even higher. So with that in mind, we're actually taking a look at, as I said, 3 highly ranked Zacks stocks that are still trading way below their all-time highs, that have not rallied as much as maybe some other stocks so far in 2023, but are making a comeback along with the rest of the market recently. So the first of those 3 stocks is DocuSign, which trades in the ticker DOCU. It is the first stock on the list today, as I said, and it lands a Zacks ranked number 1 strong buy, and it trades almost 80% below its all-time high. So let's dig into why investors might want to consider putting DocuSign at least on their watch list to close out 2023. So DocuSign sells a suite of software offerings highlighted by its e-signature portfolio. Its offerings also include document generation, contract lifestyle management, and more. So DocuSign sells industry and department specific solutions and has tons of pre-built integrations with big names in the broader business software world. So its revenue boomed leading into COVID, and then obviously as the economy is moving into a digital everything world, where everything from mortgage documents to legal documents kind of live in that electronic format, and you're not even signing anything in physical paper. So the company boasts that it has over 1 billion users worldwide and 1.5 million paying customers. And they note that 25 out of the 25 top Fortune 500 financial companies all use DocuSign, and the top 25 Fortune 500 healthcare companies all use DocuSign. So it's important to know, as I mentioned, healthcare, legal documents, as I said, like mortgage documents, a lot of that there's so much paperwork, and now it's all living online. So that's the broad bullish case for DocuSign. And its revenue soared following its 2018 IPO with 4 straight years of between 35 to 45% revenue growth. But then it only grew its revenue by 19% last year. And DocuSign is also facing obviously that difficult to compete against stretch of growth, and then a broader slowing economy, growing competition from other players in the software and e-signature space. And also, just as more companies have already dove into all of the business they need to do online, there's just a little bit less room for that massive growth that we saw during COVID, where everyone had to rush overnight to say everything's going online and we're living in this completely remote world. And as we get back to a more hybrid environment, there's just slower growth, which is why the company has been forced to respond to that slowing growth and higher interest rates, like many of those former growth at all cost firms. So they've been cutting jobs. They had some leadership changes over the last year to adapt to this new world, and they've also been focusing on the bottom line in a crucial way, and it will be crucial going forward for the company. So their most recent quarter, they topped our adjusted earnings estimates by 30%, and they've now topped our adjusted earnings estimates by 25% in the trailing four quarters, And they reported a GAAP net income of 19 cents per share last quarter versus a loss of 15 cents per share in the year ago period. And this was on December 7th. And they also upped their outlook. So their total Q3, and this is their fiscal 2024 already, revenue climbed 9% with subscription revenue up 9%. The firm's also working to kind of boost its offerings and set up better integrations with other big software providers. So looking ahead, we're calling for about 9% revenue growth this year, then another 6% revenue growth next year. So we can see a big slowdown from that massive growth over the last several years to get up to go from 5.2 billion last year to 2.9 billion next year. So solid growth, but just nothing like the 35 to 45% growth. And then on the bottom line, we're calling for 40% adjusted earnings growth this year, and then roughly flat earnings growth next year. That said, we could see those revisions trend higher as the company provided upbeat guidance when it reported earlier this month for both 2024, so the current year, and then next year as well. DocuSign, as I said, on the stock price is still down 80% from its highs and trading roughly at 2019 levels, and it's only up about 2% in the last year versus tech's about 45% climb. That said, though, it is now up about 32% in the last month. It's surged above its 50-day and 200-day moving averages, but its valuation levels are still pretty out of whack. So overall, investors might want to consider putting DocuSign back on their watch list just because it's trading 80% below its all-time highs. You'd think that maybe as interest rates start to go down, there'd be more room for these growth stocks to catch some more interest on Wall Street again. And as I said, they're operating in a business that certainly isn't going out of style. The growth will show you that. It's just not going to be growing at that rapid pace that it had been. Now we're going to go to a much larger company that operates in a totally different area of the economy that's also been hit hard, but not as hard as DocuSign. That is Nike, which trades in the ticker NKE. And we should note right off the bat that they're expected to release their Q2 fiscal 2024 results on Thursday, December 21st, so right before Christmas next week. And Nike is still trading about 32%, roughly 32% below its all-time highs heading into that report. And Wall Street has kind of punished the wider consumer discretionary space and Nike specifically for various reasons, including some growing competition. So let's take a look at some of the current issues and then jump into the broader case for why you might want to buy Nike. So it's facing kind of increased challenges from relatively new brands. So Hoka and On in the running shoe area. I'm sure some of you have either owned those or have seen those kind of pop up over the last several years. And those are all very focused on running and lots of support for your body and your feet and all of that. And those shoe brands are also gaining steam, say for doctors and nurses who work at hospitals and other places where people are just looking for comfort at all times. So Nike's been racing to kind of roll out more shoes in that running space that are really focused on maximum comfort and support. Adidas and New Balance are also making headway in that streetwear space that Nike's dominated for a long time. They're bringing back old models and just rolling out efforts that have done well. So Nike is facing more competition in various areas. It's said that sales in its footwear in North America, which is the largest market, fell 2% last quarter, and that higher prices for its shoes were offset by 10% decline in sales volume. So that's obviously not the best sign, but once again, overall, those are the near-term worries. Nike still remains one of the heavyweights in the broader sportswear world. Obviously, they're facing some increased competition, but there's no reason to think that Nike's just gonna fade and fade and fade further. They'll hopefully kind of re-cement themselves as the top performer in the space and be able to roll out more effective offerings as they try to push back challengers such as we said On and Hoka and Adidas and even Lululemon and other smaller digital native brands, because they're still kind of attaching themselves to the biggest sports and the most popular athletes, and they're still one of the most valuable brands in the world alongside the likes of Coca-Cola and other companies like that. Nike also continues to invest in the future through shopping apps and its wide-ranging digital marketplace. It's also gone kind of all in on its own e-commerce and direct-to-consumer offerings. They're cutting back a lot of their wholesaling to other retailers, so they're trying to boost their margins that way and just create that brand cachet at all times. So overall, the company's still posted really impressive growth. So over the last 3 years, they did 19% growth, 5% growth, and most recently they did 10% revenue growth. So their only setback was during that COVID period over the last roughly 10 years. That said, their first quarter revenues of this year were up about 2%, with Nike's direct revenue up about 6%. That said, though, they're dealing with some margin pressure. Their selling and administrative expenses were actually up 5%. That said, though, they topped their earnings or adjusted earnings estimate by 27% last quarter, and its overall earnings outlook has improved enough to help it land a Zacks ranked number 2 buy at the moment. And its broader shoes and retail apparel industry is in the top 23% of over 250 Zacks industries at the moment. And looking ahead, we're calling for about 4% revenue growth this year and then another 9% revenue growth next year. So getting back to that impressive top line growth. And then on the bottom line, we're calling for 16% adjusted earnings growth this year and then another 17% adjusted earnings growth next year. So really strong and stable bottom line growth along with that top line growth as well. So despite all of these worries and fears about increased competition, the top and bottom line are still looking like they're going to post impressive results. And Wall Street's still relatively high in the stock. So of the 28 brokerage recommendations we have for Nike, 17 are coming in at strong buys, with 3 more at buys and only 1 sitting in a sell ranking. Nike also has a pretty sturdy balance sheet and it pays a dividend. That said, the stock's only up about 5% in 2023, which is actually kind of the bullish reason why you might want to get in. So the stock has, though, soared around 30% since its last quarterly report, and it's now back above its 200-day and 50-day moving averages, and it is back above its 50-week moving average, and it's currently testing its 200-week moving average. So these are those really long-term moving averages. So if it is able to get right back above that 200-day moving average, we could see Nike kind of break out of its recent trading range and start to ramp back up to hopefully those all-time highs. As I said, it's still trading about 30% below those levels. And then in terms of valuation, it's trading at about 29.7 times forward 12-month earnings, which is not too far above its decade long median. And then in terms of its PEG ratio, which factors in that longer-term growth outlook, it's actually trading well below its median over the last decade at about 1.8. So that's factoring in that longer-term earnings growth outlook that we kind of touched on recently. So the longer-term bullish case for Nike is somewhat firmly intact despite all that competition. So investors might want to consider Nike, though obviously with its earnings report next week, you might want to maybe wait to see what their guidance is. But if you're a longer-term investor, Nike's trading 30% below its highs. It's still a giant of its industry. Might want to consider it at the moment. And now we're gonna close out with Target, which trades on the ticker TGT. The company crushed our Q3 earnings estimate in mid-October and provided pretty upbeat guidance that sent the stock soaring again. Despite that, though, it's still down about 45% from its peaks. So let's kind of start with the bad, as we did with Nike, and then move into the broader case for why you might want to buy Target. So the stock was a big pandemic and post-COVID superstar. Target, kind of like many others, though, then failed to adapt to that quickly changing shopping pattern, and it suffered through a pretty brutal 2022, full of inventory issues and lagging sales. It also got stuck, as I said, dealing with a ton of inventory issues. They simply had just too much of the wrong stuff. Consumers spent that year plus buying furniture and appliances and TVs and pretty much everything else that are not necessities. And the inflationary crunch then obviously started hitting shoppers, and they already just bought so much of that stuff. And even as consumers are still spending, they're spending more on things like going out to concerts and dinners and less on, as I said, buying. You don't need a third TV or anything like that most often. So Target's dealing with that. They've also been hit by some theft issues, and then they've gotten caught up in some political focus controversies. So these are some reasons why the stock has been hit so hard, as I said, trading about 45% below its peaks. So now let's kind of turn to the recent report and what to look for going forward. So the company's third quarter operating income margin rate of 5.2% was 1.3% higher than last year. So it's improving that gross margin. Its net income was up 36% as well. And then at the end of Q3, its inventory was 14% lower. So it's getting rid of all that excess stuff that it didn't need anymore, which is a solid sign. It beat our adjusted earnings estimate by 42%. So it's now topped our bottom line estimate for 31% in the four previous quarters, and it boosted its guidance. So its earnings outlook for 2023 is up 10%, and its outlook for 2024 is up as well. This helps it land a Zacks ranked number 2 buy at the moment. And its broader retail discount stores industry is now in the top 30% of over 250 Zacks industries. In looking ahead overall, so we're calling for a whopping 39% adjusted earnings growth this year, and then another 9% bottom line growth next year. Top line, though, we're still calling for about a 2% decline in sales this year, and then roughly flat sales growth next year. As I said, this is coming up against a pretty rapid period of massive growth that was always going to be hard to compete against for a company like Target, but it seems like they're going to at least be growing their bottom line in a big way, and then in the next few years look to return to sales growth as the economy and their business stabilizes in this post-COVID, more normal world again. So the long-term positives are still kind of there for Target in this post-pandemic world. They're a one-stop shop. They're not as one-stop shop focused as, say, Walmart, but they're focused on other areas that maybe Walmart isn't able to do, and they're very successful with their in-house brands, and they've been able to establish themselves as a go-to store for some key demographics. So these trends should be able to hold longer term, but obviously management must remain diligent, and they don't certainly want to get caught up in any more fears about this ongoing theft issue and the culture war. Those are some things that are still maybe plaguing the stock. But overall, it's still down 45% from its peaks and still down 5% in 2023. And it's just hard to imagine that the stock is going to be beaten up for too much longer without people at least saying, hey, Target's still operating a pretty great business. And those issues on the inventory front, at least, and the crazy post-COVID shakeup of consumers are going to normalize. So the stock is still up about 125% in the past 10 years to match its broader econ sector, and 300% in the last 15 years. And it's also up about 30% in the quarter. It's now testing its 50-week moving average. So that longer dated moving average could be a big sign for it to get back on the right direction. And it's now soared above its 50-day and 200-day moving averages recently. And it's trading at about 15.4 times forward 12-month earnings, which is a 30% discount to its retail wholesale sector and 32% discount to Walmart. So certainly worth considering Target at the moment, as it trades still way below its highs and at a solid discount to its industry and some of its rivals like Walmart. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. Remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.